out for her.
Yeah, she definitely has. It's great stuff.
All righty, good morning. I think we will start the video now. Actually, I have a couple of videos that I want to show because it's very important. All right. For everybody who knows me, y'all know I love Oliver Velez, and I think he outdid himself with this 20-minute rant. You know, but as a trader, I think we all need to hear it. For those of you who don't know Fred or altcoin, he's been at this for a long time. Great trader, has schooled most of us on Nas, and he just dropped a testimony that was sobering, in the chat. So I think now is a good time to like take a step back and look at it. We all have the propensity to make a living through trading, to make a lot of money, to make life-changing money, to make more money than we've ever seen come into our accounts. But we all need to be responsible, at the same time. And, part of that responsibility is doing the right thing every time we trade, right? And taking care of our mental health, along the way, because trading is probably the most emotional thing that I've ever done. You feel invincible after you win, and after a string of losses, it's probably the lowest that you will ever feel. So just keep that in mind, as you're putting these trades in, and never allow, your emotions to get too high or too low based off of this job. At the end of the day, this is a job. We do this for freedom, for time freedom, for financial freedom. But at the end of the day, it's still a job, and we can't attach our value to this job. So without further ado, I'm going to get into this video by Oliver Velez, and it's called, I think it's like the 10 things you need to know to day trade, what you need to day trade, basically. This video is called What You Need to Day Trade. We're about 21 minutes into the video, and then I'll let Oliver take it from here.
Yes. Can you become rich being an employee? I guess it's possible, but it's not probable. You can earn riches at this activity. But this is a perfect segue to go into the cons, guys, the cons of day trading. This is an area that most people don't ever talk to you about. But let me tell you this. No one in this entire world can ever fault me, Oliver Velez, for not sticking the cons in your face. Every time I grab a mic, every time I've been offered the ability to speak from a stage or a podium or speak into a mic, whether it's from my desk or whether it's for an organization or whether it's for trading group, the last 26 years being a devoted evangelist for this industry, I have never skipped an opportunity to put the cons in your face, because I think the cons, understanding them, is actually more important than recognizing and understanding the pros. Let's get to the cons. Con number one is the most important con of all. Odds are against you. Traders, listen to me carefully. The odds are against you. Traders, listen to me carefully. The odds are against you. One more time. Listen to me carefully. You will never be able to fault me for failing to tell you this, for failing to put it in your face, for failing to shout it as loud as I possibly can. The odds are against you. Why? Because there's a 92% failure rate in the short-term oriented trading space. That's right. 92% of every one of you listening here will fail. 92% won't make it, no matter what you do, no matter how hard you work at it, no matter what your intentions are. 92% failure rate, and not me, not any firm in the United States, not any firm internationally, not any expert, not any mentor, not any trader, not any trainer, not any mentor can change this statistical fact. It is etched in stone. 92% failure rate. Now breathe that in, traders. I need you to understand this. I need you to understand what you're up against, because you ultimately, at the end of the day, are going to have to answer this question. This one very, very important question, traders. You're going to have to answer this. Do you understand? You're going to have to answer this. Do I have what it takes to be 8%? Guys, this is a simple game, but it's not easy. There is a huge difference between simplicity and easy. It's simple. Markets go up, markets go down, sometimes they go sideways. 3 possibilities: up, down, sideways, up, down, sideways. That's a simple, rudimentary mechanism. But I am the last person on planet Earth that will tell you that this activity called day trading in particular is easy. It's not easy. In fact, it's one of the most challenging activities you as a human being will ever pick up. Do you know why? Because in order for there to even be a hope for mastering the market, you have to first master yourself. And let's face it, how many people actually master themselves in this world? How many people actually reach a point where they do what they say they're going to do? How many people really keep their promises to their kids, their wives, their husbands, their community at large, their societies, their personal God? Very few people reach the point in their life in anything where they have accumulated or accomplished self-mastery. But the only way to have any chance at success at this is to first master yourself. You can't take an unmastered you into the market and think that there's going to be success in the market. You can't take an undisciplined you and go find success. You can't take an untrained you and go into the market with your untrained self and think that you and your untrained state is going to pull money out of the markets. Won't happen. You can't be an ill-informed individual and take your ill-informed self into the market and pull money out of the markets. You can't take your unmastered self. You can't take your undisciplined self. You can't take your untrained self. You can't take your uneducated self. You can't take your uninformed self. You can't take who you are right now without changing yourself first. You can't take who you are right now and take who you are right now in the market and expect the market to give you money. So what must happen? You must first change. You must first go through a metamorphosis. You must first become educated. You must first become discipline. Discipline is not something you're born with. It's something you work on, like your muscles. You got to hit this thing up every couple of days, every day of the week, if you will, to build that muscle, to build that, to build that capability. You have to work on becoming disciplined. You have to work on becoming educated. You have to work on becoming experienced. This work happens first. And it is this work that transforms who you are. Then you take the transformed you into the market, and it is that transformed you that starts producing progress. But if you think that you can stay who you are without putting work into creating the change you need in yourself, you think there's just, I take this 2-day course and I go into the market, 2 days, it's not enough to change who you are. Take this 2-day course, go into the market, open up an account, and I should become rich in the next few weeks. Then you should really find another freaking planet to work on, because you are living somewhere in outer space, not here on planet Earth. I don't know about any other planets, but that doesn't work here. Not on planet Earth. I have yet to do intergalactic travel. I'm waiting for Elon Musk or somebody to to make that possible. But until then, I only know what the situation here is on planet Earth. This industry has a 92% failure rate, largely because people don't want to go through what it takes to become someone different first. They want to stay who they are and take who they are into the market and take money out of the market. It will never happen. My mother used to say, Oliver, never say never. Oh, never say never, Oliver. Well, I'm telling you, Mom, sorry, never. Let me say it again. Never. All right, guys. I know I'm silly, but it's a point worth. I'm telling you, it's a point worth belaboring. Right? 92% failure rate. Get it locked into your head. Most people know nothing about financial markets. They think they do. Oh, well, the market goes up and the market goes down, right, Oliver? That's it? Yeah, that's pretty. Most people know nothing about financial markets. That's a con. Here's another big one, guys. Success comes after experience, and experience takes time, years. You can't be an experienced trader in 2 days. You can't be an experienced trader in 2 weeks. You can't be an experienced trader in 2 months. Becoming experienced takes time. You can't cheat experience. All right? Anything good that happens before you are experienced is called luck, traders. Only what happens after experience can you claim as yours. Listen to me carefully. You can't become successful before you become experienced. Get this in your head, people. You cannot experience true, real success before you become experienced. True, real success comes after you become experienced. And what's required to become experienced? Time. This is what people do not want to put into this. They want a microwave. They want a microwave results. Can I have my gourmet meal in 15 seconds? No, cannot. This is the number one reason why there are so many scams in this industry, because these scammers, right, which even I, believe it or not, have been accused of. Are you kidding me? Putting this truth in your face? How? How? But this is the number one reason that scammers in this industry get away with their scams, because they sell you on the idea that anyone can do this. They do not tell you that 92% of the people are going to fail. They do not tell you that this is difficult. They do not tell you that you're going to fail first until you become experienced. They do not tell you that experience takes time. They do not tell you that success happens after experience. And before your experience, you're going to be a loser. Reason why? How many people are in this room? Check for, there's 427 people in this room instead of 40,000 people in this room. Do you know why? Do you know why there's only 400 people here instead of 40,000 people? Because I tell you this truth. 92% of you are not going to make it. There's only 400 people here because I tell you that success comes after experience. There's only 400 people here because I tell you that experience takes time. There's only 400 people here because I tell you what's real in this industry. If I went at 40,000 people in this room, I would constantly preach from every podium I can that everyone can do this, that you're all going to be successful, that it doesn't take time. Just follow these 3 things and get rich. I would have 40,000 people in this room. But I will never do that. You learn how to win in this business by first learning how to lose. Can I repeat that for you? Learn how to win by first learning how to lose. What does that mean, traders? You're going to lose first. What does that mean? You are going to become an expert loser before you see a single dollar, before you get winning trades consistently, before you call yourself a success, before you start to support yourself with this activity, you are going to be one of the greatest losing traders you have ever seen. You're going to become an expert at losing. You're going to become so intimate with losing, you're going to feel like this is just your natural state. You lose your way to success in this business. There is no way to win first, because winning doesn't come before your experience. Experience comes after you have lost tens of thousands of times. Guys, listen to me carefully. I get very, very emotional about this, and I apologize. It's just the way it is. It's just me. I get emotional about this because I need all of you to understand this. There is a direct link between how much you lose first and how successful you are later. And isn't it ironic that what all of you are trying to do is you're trying not to lose the very thing that you need to do. The very thing that you need to do now is to lose as much as you possibly can to get the losses out of the way now. You don't want the losses in the future. Just get the losses out of the way. Become so intimate with losing. Become so intimate with every possible error, every possible mistake. Know it like the back of your hand, so that at some point, the market can no longer fool you. The market can no longer trick you. The market can no longer surprise you. You've been there. You've done that. You know every possible mistake that can be made. You know every possible error, every booby trap, every dead end. The market loses its ability to punch you without you seeing the punch coming. How do you get to that state? You become an expert loser. Why is this a con? It's a con because most people don't have enough money to get through the losing period that happens first. First of all, they enter the game with this Mickey Mouse Disney idea that I'm supposed to win from day one. This is not Disney World. I'm sorry. This is not a Disney movie. This is real life. It is impossible for you to win until you become experienced. And it is impossible to become experienced until after you have become the #1 expert at what? Losing. How does a baby learn to walk? By running first? Wait, I'm going to learn to walk by sprinting first in the Olympics. Then I'll learn to walk later. No, a baby learns to walk by first trying to stand and falling. Standing, falling. Trying to stand, fall, 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 fall less. Fall less. Stable, don't fall often. Take a step, fall. Take a step, fall. Take a step, fall. Take 2 steps, fall. Take 2 steps, fall. Take 3 steps. Falling, 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 until the baby becomes so intimate with falling and all the reasons for falling, he naturally starts to avoid the reasons, but not before becoming intimate with every possible way to fall. Doctors tell us that parents who overly protect their children from falling wind up with clumsy kids. Zero athletic ability because they weren't allowed to fall enough. You lose your way to success at this business. Why is this a con? It's a con for 2 reasons. Number one, most people start off with a tiny bit of capital, and then they lose it because the first period has to be lost. The first period of a baby learning to walk has to be falling. You're always bad at something in the beginning. Always. First time you pick up a basketball, you're horrible. First time you put a golf club in your hands, you're really horrible. My golfers out there know that. The first time you try to kick a soccer ball and control it, you're horrible. The first time you try to walk, you're horrible. The first time you try to talk, you're terrible at it. You are bad at everything you start off, but somehow when it comes to this activity called day trading, that all of your common sense leaves your God-given head for some reason. And for some reason, this is the only activity that life is supposed to be different. No, I'm supposed to be good at this from day one, right? Really? You don't apply that common sense measure to anything else in life. But when it comes to this, you expect to be good right away. You expect not to fall. You expect not to lose. You expect to make the ball in the basket every single time. The first time you pick up a basketball, really? How can that be? Why is this supposed to be the exception to you? You're going to be bad at this. You're going to lose your money first. Absolutely. You're going to fall first. It's just the way life is. Again, I don't know about life on other planets. We're still waiting. But life here, you lose first in everything. In everything. You understand what I'm saying? Are you picking up what I'm laying down? Am I talking too much? I am frustrated at the level of naivete, and I'm frustrated at the lack of common sense when it comes to my industry. I'm not here to sell you on some pipe dream. I'm here to speak some much needed reality to you. This is not easy. But I, for one, am glad it's not easy. I don't want to be a master at something that's easy. Oh, I'm a master. Did you know I'm a master at walking? Oliver, what's the big deal? Everybody can walk for the most part. I don't want to be a master at something that everyone else in the world can be a master at. I want to be a master at something so difficult that most people say, oh my God, really? How did you do that? Can you talk to me? Can I take you out to dinner? You want this to be hard. You want it to be difficult. You want it to be challenging. You want to be special. You want to be the minority. Who wants to be the majority? You want it to be difficult, but at the same time, don't be naive and think that it's going to be easy. It is not going to be easy. It is not. But at the same time, be glad it's not easy. Because if you happen to make it, oh my God, you are truly special. You're the 8% and not the 92%. That should be your motivation. That should be your goal. I want to be the 8%, and I will work at being the 8%. I will put the work in. I will put the time in. I will become experienced. I understand that I'm going to lose first. I understand that inside of every single loss is the seed of a future win. I understand this. Losing comes first, Oliver. I understand this, and I will work on perfecting my losing until I lose less, and until the vast majority of those losses go away. You have to be willing to do that kind of work and have that kind of determination at this. Otherwise, you're wasting your time, you're wasting your money, and you're proving every naysayer right in my industry. What the naysayers say? This is not for you, that this is stupid, that this is gambling. They call my industry a fake, a scam, and it's not. But many of you make them right. You turn this game, this professional game, into a casino because you're gambling and you're not trading. You play this game like it's a Disney movie, like you can all of a sudden, somebody can wave a wand and you're all of a sudden a successful trader because you took a 2-day course from somebody. What? A 2-day Disney wand to become successful. That the real world doesn't operate like that, traders. I'm sorry if I get so animated, but it's incredible.
All righty. So that's the 20-minute rant from Oliver Velez. Oliver Velez said a lot, I think he put it pretty eloquently, and honestly, I think he was pretty straightforward. Um, Trading is something that's going to come to you over a period of time, whether it's months, years, um, days, nobody's going to get this overnight. So if you came with that expectation, you're in the wrong place. If you came with the expectation that you wanted to learn over a period of time, you're exactly in the right spot. None of us are required to use real money when we learn to trade, right? You could very well be in a demo account for 5 years. Now, when you go live, obviously there there will be a rush of emotions that will play onto your trading, and it may take you a while to figure that piece out, but it will be a lot better for you, in my opinion, than trading with real money from the jump, like I did. There is no substitute for the work that you must put in as a trader. You say that one more time. There is no substitute for the work that you must put in as a trader. I have one more video that I want to show, but before that, I just need to. There's a chat that I had to delete this week because it was in the wrong. It was in the wrong area. Okay. Tanisha or TT, started a chat, and we were in like the devotional section. So shout out to my man Malik. He dropped a trade idea that I had posted on EA that was dead wrong. If you've been in this group any amount of time, you will probably notice that wasn't the first trade idea that I posted that was not correct. I'm very transparent when I tell you guys that every trade idea that I post does not come to fruition. It's a trade idea, and it's going to be based off of a concept that has been proven, right? But just because you trade via concepts or based on concepts does not mean that every trade is going to work out. For those of you who know me, most of my trading is based off of concepts that are taught by ICT, whether they're stop runs, whether they're liquidity runs, whether they're even this weekly strategy that I used is based off of an ICT concept. He doesn't use it on the weekly candle. He trades a lot lower time frame, but the concept is the same. And I'm just going to take the time to show you the exact concept today. But I can't stress this enough, guys. First of all, if you had taken that trade idea and hedged like me, you should have made a killing, right? Because if you had hedged it and the trade went against you, I think that trade went like 300 pips in the opposite direction, and it was because of the news. So most of you know that if I trade a news setup, I'll normally trade it live, or you guys have seen how I trade the news setup. I'm going to put my position in a place that I believe that the liquidity needs to go. I didn't trade that particular pair because I traded two other pairs. But I don't know if that gentleman traded that pair, but I asked him and he said he didn't. But it was the news that came out. If you're going to trade over news, it's high risk, right? I wouldn't suggest anybody trading news unless they've done it before. But if you traded that pair and you hedged it, I think it went 300 pips in the opposite direction. It was an EA trade. I don't mind anybody, calling my trade idea bad. I don't mind that. That's not it. But I don't want you to take an idea that I post and just trade it without doing the research, right? Without understanding the news, without understanding the risk. That's not the point of this group, right? It's the number one reason that I don't post signals. I'm not here to give you signals like we did in Ruby's class. I believe that signals encourages laziness. Signals kind of put training wheels on a situation and it stunts your growth. We're all here because we want to be able to go out here and find our trade setups as individuals. And that's why when you guys ask me, hey man, how do you enter this trade? My answer is always, everybody should have their own individual entry method, right? Whether you enter off of a break of structure, you enter off of a break and retest, you enter on an order block, you enter because it's a supply or demand zone, however you enter the trade, right? Because the truth of the matter is, some of us are going to be more aggressive than others. So my only aim is to give you the concepts and give you the reference that I found the concept. And then you go do your own back testing and your own research. And maybe you come up with something different on a trade. Maybe you come up with the same thing. But at the end of the day, our trade ideas are just going to be trade ideas and they have to play out, right? So I don't mind that, I even encourage it, drop the trade ideas. They're either gonna come true or they're not. But when you drop trade ideas as the individual trader, trust me, it's 3 or 4 people in the chat that are waiting on those trade ideas, right? Maybe they have their own idea and they're just timid. They don't want to drop their trade idea. But if you drop your trade idea and it's opposite of their trade idea, that might help somebody. Maybe they will hit you up, or maybe they'll go look at it again and say, man, I wonder how they came up with that, right? That's the purpose of having this community. We have over 600 people in this community. There should not be a dry trade idea spot. We should all drop our trade ideas. When I have these meetings, I tell you exactly what I think. And I'm not telling you based on a whim or whatever. I've looked. And this is what I truly feel. This is what I think based on whatever chart information. That doesn't mean that I see it 100% correct. I mean, me and Kim disagree a lot of times. It's great because you want people who see different things. Me and Alicia, that's one of the reasons why me and Alicia are so tight, because she saw things that I never saw. She was right more than me all the time. Now, as far as her getting her emotions together, maybe that'll be one day in 2023. But you need the opposite. You need, I guess, antagonism when it comes to trading, because you get brainwashed, or you fall in love with a trade idea based on what you see. And there's power in other people commenting and telling you what they see. That's why I love Rosebud. That was one of the reasons why I hit her up and asked her to come to this chat when she was in Ruby's group. She used to trade Nas, I believe. But her ideas, a lot of times, were different than my ideas. A lot of times they were better. She didn't trade the same way I traded. You need people that see things differently. You need ideas that come from a different space. When Rosebud broke down her entry method and her trade setup, it was completely different than the way that I trade. But somebody on these calls needs that information, because they will never trade the way that I do. So I want to encourage you guys, drop your trade idea, chop other people's trade ideas up. There's nothing wrong with that. There's power in that. That's where we want to go to as a group. And, you know, I'm not saying, you know, call somebody dumb or whatever, right? But, you know, just say, I don't see that. How are you seeing that? You know, I mean, this is what's going to help you grow as a trader. So hopefully, in the future, you will continue to call out the idea. But there's more power in calling out the idea before the trade happens, instead of after the trade happens. Just my thoughts. I'm going to switch videos here. But first, I'm going to drop this video in the chat. I don't want the woke person chewing me out for not dropping the video. All right, that video is dropped in the chat. Video by Oliver Velez. I will switch, and I believe this video is about 20 minutes. I always ask you guys to come watch the source, right? So for those of you who are curious about my weekly strategy, this is it right here. It's the ICT Power of 3 video, right? The Power of 3: accumulation, manipulation, distribution. So this is why I trade the way I trade on this weekly time frame. Now, when you hear ICT talk about this, he is not going to be talking based on the weekly candle. So you're going to have to extrapolate the information and lay it across what we do on the weekly candle. It's only 20 minutes.
Hey folks, welcome back. Okay, this teaching is going to be specifically dealing with accumulation, manipulation, and distribution. Okay, the ICT concepts used in this module. The ICT power of 3. Importance of developing anticipatory price skills. Engineering liquidity in the market. Neutralizing liquidity in the market. Market making and pairing of orders. What accumulation looks like in bull and bear conditions. Where does manipulation occur in bull and bear conditions? What distribution looks like in bull and bear conditions. All right, so we're looking at a crude depiction of a open, high, low, closed bar. And for the purposes of this teaching, every individual bar or candle is going to be referred to as a daily range or daily bar. Okay. Now, everything I'm going to suggest to you here is applicable to every time measurement. Okay. In other words, every time interval, if it can be charted, this same phenomenon or concept can be applied to it. So regardless of what time frame you can pull up and form it into a chart, as long as you have a beginning time, the highest value, the lowest value, and an ending in terms of measuring time, this concept is applicable. Okay, but for the sake of our discussion here, and for something you can practice and look for a few times a week, The ICT Power 3 is basically a concept of looking for accumulation, waiting for manipulation, and then looking for a period of distribution. Now, I look at candlesticks because it helps to be able to see after many years of looking at price action. It's very hard on your eyes. As long as I've been doing it, staring at it, spending lots of time in charts, both on a screen and on paper, I can see that my eyesight has diminished over the years. One of the benefits of knowing what you're looking for is spending far less time in the charts than most traders that, like me and before me, we spent a lot of time researching and looking at things. So I gravitate towards candlesticks because it's easier on the eye. Not that there's any magic behind it, but the same concept is seen here with a bullish open, high, low, close bar to the left is comparable to what you would see in a bullish close candlestick. Much easier to see by staring at that versus that little tick to the left or the little tick to the right that distinguishes the open and close on individual candles or bar. Okay, so back to our discussion. Using the open, high, low, close bar, it's going to be a lot easier for me to describe the phenomenon that makes up my ICT Power 3. And the origination behind this idea was inspired by my mentor, Larry Williams. He made a point in one of his lectures that he ended up repeating several times for a number of years, but he made a point of making a remark about he wished he knew how the traders or who the traders were that could be buying below the open or selling above the close on bullish or up close days. And I took that as a personal challenge, and I spent the first quarter of my 25 years mastering just that concept because I felt that it was enough for me to work towards, cracking that code, if you will. And I think I've done it. I've taught it to other people, so I know that it's something that is real, it's tangible, it can be repeated not only in my own results, but other people that have learned from me. But it all hinges on the reference point that starts our time interval. And again, we're referring to every bar or open, high, low, close bar depiction in my diagrams as a representation of one daily bar. Okay, so a full 24-hour period. It does not matter that if it's forex or commodities or bonds or whatever it is. If it's a market and it can be measured in time intervals, the highest value, the lowest value, a time at which it starts trading and a time it ends trading, you only need those 4 reference points. So the open, high, low, and close is all we're concerning ourselves with here. Now, the first of the 4 is the opening price. Now, for definition terms, this is the initial value price prior to any imbalance. And I'll talk more about that as we go. The closing price is the ending value price post price imbalance. Okay, the portion that makes up the range between the open and close is referred to as range expansion, and this is a dynamic price imbalance. Now, this can be a bullish or bearish imbalance relative to the open, but for example's sake, our first one's going to be referring to a bullish up close. So this would be a bullish range expansion or a dynamic price imbalance of a lot more movement to the upside, seeking a higher price above the initial value price of the opening price. In layman's terms, we're looking for a bullish close. Okay, now as far as it goes in terms of accumulation, manipulation, and distribution, or Power 3, the first thing we have to determine is what is accumulating. Now, if we're bullish on the marketplace, we would be looking for accumulation in the form of long positions building up. It's going to be around that opening price, and I'll talk more about the opening price in future tutorials. But the opening price, just above it or below it when we're bullish, that's where longs are accumulated. Now, who's accumulating those long positions? Smart money. When we're bullish and we're anticipating a bullish range expansion to the upside, okay, or a higher close, we would be hunting a manipulation cycle immediately after the opening price. So on a daily range, that opening price, if we're bullish, we want to be buying at that opening price or below it ideally. Why would we want to be buying below the opening price when we're bullish? Because the market makers are going to be looking to engineer short liquidity. What does that mean? If a market breaks quickly below an old low, there are traders that look to be a breakout entry. So they'll look to sell short on a stop. This engineering forces liquidity in the marketplace to sell at a very, very low price. That run below an old low or a quick sudden movement will entice traders that are on the sidelines just watching price. And you know what that feels like if you watch lower time frame charts. Any sudden move lower, your heart starts to have palpitations, you get excited, you think it's going to keep going lower. What happens? You take the bait, you go in there and you sell short, and the market stops on a dime, reverses, goes north. Immediately below the opening price on the daily range, when it's bullish, this initial drop down is very significant because it's going to engineer willing parties to sell short. That selling short will flood the market with the counterparties to smart money wanting to buy it at a deep, deep discount. The other form of manipulation that takes place when it's bullish is neutralizing long liquidity. That means there's individuals that's probably already long or just recently bought near the opening price, and the drop down below the opening price will upset their long position. In other words, it'll just run their stop, not to engineer them into a new lower entry, but to knock them out of an initially well-placed position. So we're seeing two conditions that are happening at the same time. The opening price and below it, when we're bullish, is knocking individuals out. That's right, that would otherwise be profitable if the market rallies. And it's also inducing or engineering of short-term sentiment shift to bearishness by running short-term lows. Not only would we take out long holders with their sell stops, but traders that want to sell short on a stop, they would be placed in on the market on the wrong side. In other words, selling short in an otherwise bullish market. So finally, as we interpret this, the manipulation is we're looking how the market makers pair orders. By pairing these sell stops with smart money buying interest, we can see the manipulation cycle as it really is. A run below the opening to accumulate long positions before the big up move. And finally, the distribution cycle, where smart money pairs its long exits, selling out of their longs, with pending buy interest. Now that pending buy interest is going to be in the form of buying above an old high. That would be a breakout artist's idea. They're going to want to break out above a previous high, and they would view that as strength, buying strength. Well, smart money will look to sell their long position to those breakout artists that want to buy above an old high. Or those individuals that would probably try to sell short intraday. They would have a buy stop above an intraday high. Smart money would look to run through that intraday high and sell it to those buy stops. So their long end exits would be paired with a short-term intraday swing high. If we've seen a nice little retracement lower intraday before the close, that's where an area of distribution would come in. So we're looking at a reverse idea here. The open high low close with a down close. And again, this representation is a crude depiction of a daily open high low close bar. And we could see that same thing in the form of a bearish closed candle. Much easier on the eye, but we're going to take our focus back to the open high low close bar. And again, the opening price, much like we just said, but just for completeness sake, it is the initial value price prior to any imbalance. The closing price is the ending value price of that time interval that you're measuring. In other words, what time frame you're looking at. If it's the daily, it's the ending value for the daily range, post or after the price imbalance. In other words, the movement that took place between the open and where it's now closing. And we have the range expansion cycle that is basically dynamic price imbalance. So between the opening price and the closing price, when we're bearish, this is what we would be expecting or anticipating in price, okay, a lower close. Now, in the form of power 3, what is accumulating? Well, from the opening, when we're bearish, short positions are building up. And who's building up short positions? Smart money. At the opening price, or just above the opening price when we're bearish, we would be anticipating manipulation. And what form of manipulation will we expect to see? Engineering long liquidity. In other words, we're looking for a quick sudden movement higher to entice breakout artists that want to buy, want to break out, and they would be placed in on the wrong side of the marketplace. Another form of manipulation, this would be neutralizing short liquidity. In other words, those individuals that would already be short in the marketplace that would otherwise profit from the future coming decline, they are knocked out by having their buy stops tripped. So they're neutralizing their short position, and their short position being neutralized is a buy stop. So that buy stop that hits the market as a market order, smart money will sell to their willing buy stop. So in other words, if the market trades up to your buy stop, that buy stop becomes a market order to buy at the market. Smart money will be counterparty to that. They will sell to those buy stops, but their sell position is to ride it lower and make money. Manipulation in its truest sense is in this form when we're bearish at the opening price or above it, buy stops are being paired with short interest on the form of smart money. And finally, at the end of the day, the distribution cycle is seen where smart money pairs its short exits or covering with pending sell interest. In other words, smart money is going to be short, and to get out of their short positions, they have to buy it back, and they will be targeting some old low. What would be resting below an old low? Sell stops. Those sell stops, once they're triggered, they become market orders to sell at the marketplace, which floods the market with sellers. And the best time to cover a short is when there's a flood of sellers in the marketplace willing to sell at a low price. And this would be the distribution cycle of the daily range. Okay, so what does accumulation look like in a bull condition or when it's bullish? It's not important that we zoom in here and see any of the details. I just wanted you to see the overall characteristics. In the green shaded area, you can see that there's a consolidation around the opening price, and that consolidation leads way to a decline, which gives us the framework for what does manipulation look like in a bull condition. Well, this is what manipulation looks like right before the market starts to trade higher, after consolidation, when the accumulation of longs are being made. The problem is you see that decline below that green shaded area as weakness. And who would be wanting to buy ahead of that? Smart money traders, okay, they have very deep pockets. And the market has a tendency of creating this fake move, okay, where it entices or induces the opposite mindset or sentiment. This drop down out of that consolidation when we're overall bullish is manipulation. It's knocking out short-term lows. So anyone that's long, they're knocked out. They can't profit from the up move. And it's also putting traders in on a breakout short, and they're going to be on the wrong side of the marketplace. And finally, at the highs of the day, we have our distribution where the smart money exits their long positions by selling above an old high where buy stops would be resting. So those buy stops would be hit, floods the market with buy stops, buyers at a higher price. Smart money is going to sell their long positions to higher buying interest traders in the form of their buy stops being tagged. Okay, and what does accumulation look like in a bear condition? We have a consolidation and price moves higher, which would be the manipulation. Now, if you look at the left side of the chart, you see a double top. That's exactly where what? Buy stops would reside. Okay. Lesser informed traders would have their buy stops resting above that. It would be viewed as a stiff resistance price point, and those levels are too clean. Market will, in fact, want to go through there, probe it for buy stops. Those buy stops are going to be triggered. Anyone that's short is now allowed to be profitable in the move going lower. So they're neutralizing their shorts by hitting their buy stops. Also, breakout artists that see that equal high to the left of the chart and the consolidation that move out of that, they would be buying that on a breakout or trying to buy strength in their eyes. Both are incorrect. And what we're actually seeing is a market driving higher to pair traders to buy higher or at a high price, and short sellers on the smart money camp, they're going to be selling short to those individuals that want to buy at a high price to make a profit as the market moves eventually lower. Towards the end of the day, we see the distribution cycle come in where short holders in the smart money camp are going to be looking to collapse their short positions. To get out of a short position, you have to buy it back. You have to look for an area to run below old lows. You look at the original consolidation, 20 pips below that, that's where we see the low of the day form. It's exactly where smart money would be collapsing their short positions for day trade move. And we see the ending cycle there, distribution. Smart money collapsing their short in the form of buying it back at an area where sellers below the market would be interested in selling. Overall, if you understand this concept, and there's lots more information that's coming by way of my tutorials, you can look at the marketplace like this and see the original consolidation here in the green. Market reaches down below the consolidation into an area of liquidity, which is 10 pips below equal lows. Those sell stops are triggered where smart money would be buying. Once those sell stops are tripped, they're buying the low of the day. The market rallies up. We have an expansion move or range expansion up into a move of running 20 pips above the old high. Then your distribution cycle goes into the marketplace, and there's a complete daily range using the Power 3 concept that I've outlined here. So hopefully you found this teaching insightful. There'll be more built on this with the future tutorials. And until next time, I wish you good luck and good trading.
All righty, good luck and good trading. So that's the ICT version of what we do. Probably sounds a little bit different, but it's the exact thing that we do when we trade that weekly range. So, these concepts aren't new. It doesn't mean that every week this plays out to a T. We have to make adjustments. Maybe on the weekly candle, it trades down into the range and then it doesn't do anything. But that's why we sell it, before we buy it, or we buy it before we sell it. So we can make sure that we come out on the right side of things. If everybody does their own research on an individual basis, then you might see a different way that you could trade these concepts, right? You could make it more user-friendly to you and your personality. Everything that I bring to you is based off of my trading style and my personality. It doesn't make it right, it just makes it right for me. So, I think a lot of times what gets lost in the sauce is that these trade ideas and these trade concepts are basically just a peek into that individual's way of seeing things, and not the only way that you can trade it. So, I just challenge everybody to do their own research, come up with your own trade ideas, and, back test them, bring them, show them to others, as long as they're successful. That's how we build a more successful trading community. Do I have any questions over anything that we've covered? Cool. Let me drop this link. The ICT link here in the chat. All right, so we have no questions? Did everybody have?
Oh, yes, I have a question. This is Rosa.
Hey, Rosa.
When I was listening to the video, I was getting understanding. He said that this concept could be used over any time frame. And I was wondering, why did you choose the weekly over any other one?
That's a great question. So Rosa, whenever I started learning how to trade, I had a job. And the easiest way for me to do it was over the longer periods of time, right? And
Okay.
so I started with the daily charts and was trading the daily charts. But in my trading, sometimes I would get ran through by that weekly move, right? And for me, it was better if I just went up a time frame and I could trade the entire week in one direction. Now, I'm not saying that on the daily time frame you can't. It won't go your direction for the entire week, but I was having trouble seeing it. So, in my time studying ICT, I started back testing, and I noticed that on that weekly candle, it was less of a chance that that it would reverse on me in the middle of a week. Now, it still can happen. And a lot of times on the weekly chart, you'll see doji candles. That's an example of the price reversing on you in the middle of the week. And the reason it does that is because you're getting a retracement from that monthly candle, right? But it's a lot less prevalent than it is on the daily. And it's a lot less prevalent than it is on the 4 hour. So the higher the time frame, the less bull crap you'll get, right? So it's going to go in your direction for a longer period of time before it pulls back.
Okay.
And that's exactly right, Mountain View. It removes the noise, from the chart. When you hear people say noise, it's all those retracements. So the higher the time frame you trade on, the less retracements you'll have to deal with. And I think a lot of times as new traders, it's easy for us to trade one direction. That makes sense?
Yes, I understand. Thank you.
No problem. Any other questions? All right. So I would encourage everybody to dip into this ICT. He has a mentorship 2022. He has like thousands of videos before the mentorship. There are a bunch of concepts that are taught that I find very useful, right? I don't trade every ICT concept, but you don't have to either. You can get one or two that you like, that are easy enough for you to follow. You can make that your trades, and it's nothing wrong with that, because you could trade one concept, only one concept, and you can be very, very successful. As a matter of fact, I think if you talk to most traders, they're looking for one or two trades per week, unless they're scalping, right? But if you talk to somebody who day trades, or swing trades, 1 or 2 trades per week. You know, a swing trader might be less than that. They might do 1 or 2 trades per month and just let it ride. So there are a multitude of ways that you can become profitable. And I think none of those ways require you to trade more. I think they're going to all require you to trade a lot less. All righty, I'm going to stop the recording here.